Most people work extremely hard to earn their money and generate an income to provide for themselves as well as their families a good life. Yet when it comes to managing that money and putting it to good use, many of us are fumbling around in the dark without a flashlight. All the effort we put into earning that money, yet we don't put in the same amount of effort into learning how best to handle it. So, even with the best of intentions, many of us make mistakes with our personal finances. Some of these mistakes can be quite costly and have repercussions on our futures for years or decades. What is a financial mistake? First, it's important to understand what a financial mistake actually is. Broadly speaking, a financial or money management mistake is an action taken by an individual that, over some period of time, which results in losses of money, weaker performance or utility of that money, incorrect strategic decisions for money management, a worse standard of living or financial flexibility, otherwise places the individual in a worse financial position going forward. Number 1. How do I stop spending so much money? One of the most common mistakes people make is spending way more than they planned on non-essentials. Often, you already spend more than you realize. That daily premium coffee, little things you pick up at the store, it all adds up to real money. It's fine to spend some of your hard-earned cash on luxuries or things you want, but be sure you can afford it and that you know how much you're spending. Number 2. How can I not overpay a house? Whether you buy or rent your home, apartment, condo, there's a good chance you are spending more every month than you should. Traditionally, experts and advisors have suggested you spend around 1 of 3 of your income on housing. That was seen as a decent shorthand method for figuring out how much home you could afford. But that doesn't take into account a lot of expenses or details and may be way too high for a lot of people in the modern era. Floor space and space in your home is all well and good. But paying an extra $100 a month on a mortgage or in rent to have space and then having a room that goes unused 95% of the time just doesn't make sense. And the bigger you go, the more other non-purchase costs increase to utilities, taxes, insurance, and more. That can all add up to buyer's remorse, especially when money is tight or the market turns sour. In good times and when your income situation is stable, it may not seem like a bad idea to have extra space. But when it's crunch time, you can be regretting the extra costs and wishing you had stuck with something a little bit smaller. Number 3. Having no plan to pay down debt. Debt can be a ball and chain that you carry around with you everywhere, dragging you down financially and lowering your quality of life. Debt can also cause a great deal of stress, strain on personal relationships, and more. While some debt is actually a positive for your credit score, most people have far more debt than they'd like and is healthy. Credit card debt, mortgages, car loans, personal loans, the interest alone on all of these can sap up any kind of extra money you make each pay period. That's money that you could be putting into savings to avoid taking on debt in the future in the first place. When you get stuck under a mountain of debt, sometimes nicknamed a debt spiral, it can be a self-perpetuating cycle as a result. You can't make improvements to your debt situation unless you develop a plan to tackle that debt. Simply paying the minimum monthly payments is extremely costly and will take years or decades in most cases. Taking out cash advances from your credit cards is even more costly. And you can't simply ignore your debt either, or you'll end up with collections agents chasing you down, a credit score that's in the toilet, and no hope of improving your finances. Therefore, developing a plan and sticking to it to tackle your current debt is essential. Number 4. Do I need to save for retirement? For many workers, especially those who are in their 20s and 30s, retirement seems like it's a long way off. Setting aside money for retirement is often one of the last things on the priority list for people in this demographic. However, as the adage goes, failing to plan is planning for failure. This age group is actually when your retirement savings are most valuable and when you are most readily able to save for retirement. Later on, if you get married, have children, and own a home, expenses increase rapidly, and you may never get around to putting enough aside for retirement. Number 5. Carrying a large credit card balance. Outstanding credit card balances and carrying a balance each month are one of the biggest ways to waste money, and almost everyone does it. Don't charge things to your credit card that you can't pay off by the end of the billing cycle. Don't spend money you don't have. Number 6. Not shopping for a lower interest rate. Speaking of interest rates, another common mistake is not shopping around for lower rates or re-evaluating your loan, credit card, mortgage, and other rates periodically. Many of the rates that are charged on credit and loan products vary with changes in the overall market and economy. By knowing your rates and periodically checking what's available, you can often negotiate lower rates, refinance loans, and save money. People often avoid this because it's easier not to change things, and personal finances can be a bit intimidating. But you can save hundreds or thousands a year that's worth some discomfort, research, and effort. Number 7. Not budgeting or budgeting incorrectly. Having a budget is critical to understanding your income and expenses. Not budgeting is a very common mistake. People don't want to make the effort or don't know where to start. But, again, the same adage as earlier applies: failing to plan is planning to fail. Without knowing where your money is coming from and how you are spending it, you can't hope to make meaningful, sustainable changes to increase your savings. At the same time, a lot of people don't budget correctly. Paycheck-based, weekly, or monthly budgeting is fine, but only if you are accounting for annual expenses, too. Amortizing annual expenses as part of a shorter-term budget is often neglected, rendering much of the budget useless. For example, if you pay your car insurance once a year and it's $600, you should be budgeting a line item of $50 per month for that payment. Number 8. How much savings do I need? This one is pretty simple. People don't have enough money set aside for unexpected bills, surprise expenses, emergencies, changes in life circumstances, and so on. The average household savings rate in Canada is between 1% and 4%, where it has remained for the last several years. That's not nearly enough. If your household income is $4,000 per month, that means $40 to $160 per month going into savings. Not counting interest on a savings account, it would take you between 2 and 8 years at that rate to save enough to replace 1 month's lost income. Not having savings is one of the key factors in why people take on so much debt and can't get out of debt. Most experts say you should have 3 to 6 months of income reserves in savings at a minimum. Number 9. Not paying attention to your credit score. Knowing your credit score and keeping it as high as possible is critical to your financial health. Too often, people only think about their credit score when they go to apply for a loan. With a high credit score, you'll have the easiest time accessing loans and credit. You'll also get the most favorable interest rates. While some people have no choice and they have to get a bad credit loan, having a good credit score means opportunities, financial flexibility, and the ability to pay less in interest. But it's not something you can improve overnight. It takes attention and ongoing work to keep your credit score high. Number 10. Why shouldn't you use your credit card for emergencies? A credit card is often not seen by people as what it is: a form of lending. When you make a purchase on a credit card, you're borrowing money from the credit card company, which you then pay back, with interest, over time. Credit cards have some of the highest interest rates of any credit or loan product. If you need affordable cash now to handle an emergency or surprise expense, don't charge it to your credit card. Try to get a personal or a short-term loan. It's a great alternative. Subscribe to the channel if you want to see more such useful videos. And share in the comments what mistakes you faced financially.